Fed raises interest rates amidst inflation concerns. What it means for the U.S. economy. Washington, D. July 26, 2023. Despite a recent slowdown in inflation, the Federal Reserve took decisive action yesterday by raising its key interest rate by 0.25 points, now ranging between 5.25% to 5%, the highest in 22 years. The move comes amidst an upbeat economic outlook, and the Fed hinted at the possibility of another rate hike in the coming months. In a statement following the two-day meeting, the Fed emphasized that its decision to raise rates further would depend on various factors, including inflation, economic performance, and financial developments. Analysts speculate that another rate increase is likely to occur in September or November, considering the resilient job market and robust economic activity. Fed Chair Jerome Powell acknowledged the recent slowdown in inflation but cautioned against complacency, as the process of bringing inflation down to the Fed's 2% target is still underway. Powell highlighted the need to strike a balance in the economy and labor market to prevent potential surges in consumer prices. The Fed's statement reflected optimism in the economy's expansion, now described as moderate, an upgrade from the previous modest growth. This suggests that the central bank believes the economy can handle another rate hike and may see inflation rise again due to solid growth. While the rate hike could cause concerns for borrowers, savers may find some relief, as higher rates could translate to higher yields on savings accounts after years of paltry returns. However, consumers should brace for higher interest costs on credit cards, auto loans, and mortgages. The central bank's efforts to control inflation have faced mixed opinions from economists. Some argue that the rate hikes have had little impact on inflation, pointing to other factors like supply chain bottlenecks and commodity prices. On the other hand, the Fed's actions have influenced inflation expectations and contributed to modestly slowing down the job market. Investors and markets remain watchful of the Fed's next moves, with some hoping for a soft landing where inflation is reined in without triggering a recession. The economy's resilience, strong consumer spending, and falling inflation provide some optimism for this outcome. As the U.S. faces the possibility of another rate hike in the coming months, uncertainty looms. The Fed's delicate balancing act aims to address inflationary pressures while maintaining steady economic growth, but the road ahead remains uncertain. Analysts predict that the central bank may now pause rate hikes for the rest of the year as inflation cools, but future economic developments will undoubtedly play a significant role in shaping the Fed's policy decisions. With the next Fed interest rate decision scheduled for September, the financial world awaits further insights into the central bank's outlook and its potential impact on the U.S. economy. As always, investors and consumers must remain vigilant, as economic conditions can change rapidly, influencing monetary policies and their effects on various sectors.